Good afternoon, my fellow taint inspectors. How we doing? I want to apologize in advance and in a tardy fashion for not making this video sooner because this should have been made a long fucking time ago, um, and it just never happened. So we're gonna kick this one off pretty quick. I'm gonna try to keep this really nice and concise, um, and just try to make it a home run within the first 5 minutes, and then anything after that will be me going on tangents and extended iterations of speech. All right, so the Wyckoff Snippy Snipe, the one and only, the motherfucking Chris Kyle of the charts. This real quick, I will do a little preamble. The origin of this script, this indicator, this whatever you want to call it, was centered around trying to find pre-calculated zones where particular meme stocks would bounce, right? And also be deflected and sent down. This started off with AMC, and that was where most of the testing was focused on, and as well as GameStop. And then, funnily, it turned out that this also works on just about every other stock. I can't divulge what exactly it does. I can kind of hint at it, try to like bridge the gap, but not actually complete the bridge, because if the bridge is completed, I don't make any money. So, all right. Long story long. If you don't have TradingView, download TradingView. If you're using it on your browser, just download it. It runs so much better, and there's a lot of really cool features you can take advantage of. So go to a stock of your choice, just for the sake of shits and gigs and walking down memory lane. I'll pull up me boy Jimbo. And so now that you're at your ticker of choice, it is now time for me to not keep fucking with everything. It is now time to go to this section right here where it says indicators. If you're on mobile, it'll be like the menu at the bottom. I think it's like 3 dots and then layout or some shit and then indicators. And then just look up Wyckoff Sniper, and you can see it down here. You can also look up Sword of 1,000 Truths, and that will also bring it up. Make sure to press the favorite icon, the star, because your boy is the fucking star here. And it also helps get some visibility on it. And click it once, and that will add it to your chart. And eventually, later in this, or maybe it'll be in another video, you can actually have multiple instances. And this gives you even more insight into your particular security. But in the meantime, we're going to keep it nice and simple. And we're going to just add the one. The default settings this ships with, there's a bunch of different things that you can tweak. If you don't know how to change the settings, go to the indicator item here. You can click the cog, and that'll bring it up, or you can double click it, or double tap if you're on mobile, and that will bring up this giant menu. There's a lot of things going on here. Please don't let it dissuade you or seem domineering to you. It's pretty like simple, straight out of the box. If you want to dive in and mess with it and calibrate it, this is how you do it. So the first, it's pretty much like these. Everything up until linear regression length is what really matters. Everything below that is more esoteric. You don't really need anything below this, with the exception of like showing signals and whatnot. But that's pretty much it. As far as what does matter, the scanning length, 11's really good. There's a bunch of different configs that people throughout the community have come up with. 11, 31, 51, those are my go-tos. That's what I have found to work the best. But please mess with it, have fun with it. Give it a good time, give it a kiss. But always feel free to experiment. The cloud sensitivity, if you are to show the liquidity clouds, right? So you can kind of think of these as like buy and sell zones. The cloud sensitivity length is basically a multiplier as to where, oh, that's a horrible fucking way to demonstrate this. This is where your actual regions of accumulation and distribution are being factored into, this blue and this red. If you increase this value, you will also increase the width, or the height rather, of these regions, which will give you more reactive. There's the burp. That'll give you more reactive signals, but at the same time, because you're capturing more signal, that means that noise will be more prevalent. So it's something that we'll get to later as to how you can calibrate that exactly to find the ideal region. Yeah, so show liquidity clouds, and then you have the show spring / UTAD region, which is the macro trend line. These are kind of like the tried and true long term, I guess. These lines also are indicating distribution and accumulation, but it's more refined, and it's not as reactive as the liquidity regions or the rubber bands, which we'll get to in a second. But these are good to have. These are really good to have, especially if you're trying to play long-term or macro movements. Show linear regression trend. This is more so just to kind of get an idea as to like what the momentum is behind accumulation or distribution. These aren't one-to-one scale-wise with price, so don't think of them as like regions of that price would react to. This is purely for just kind of gauging momentum and gauging like what direction things are starting to head in. It's a latent / lagging metric to work with. I typically keep that off unless I'm trying to like dive into some really like macro stuff. It doesn't really have much practical application. And then factor average shoe range in the rubber band moving average. If you're playing shorter term time frames, it's like anything. I mean, you can still do daily. It's more so the if the smaller your scanning length is, the better it is to have this turned on. Essentially, wherever that accumulation and distribution are taking place, that the indicator is calculating, if you have this turned on, it will either shift distribution down and shift accumulation up. I think I have that right. It might be the other way around, but it's just it's a way to potentially eliminate noise, but at the same time it can add it. So we'll get to the calibrating thing here in a second, because we're just about done walking through all this. Yeah, that's pretty much it. And then if you want to have signals turned on so you can see exactly what's going on, you can do that. The show buy sell signals and show buy sell signal type, same thing. One of them just shows what is calling for that particular up or down movement. Yeah, my autismo brain is going a fucking million miles a second right now, trying to explain and not think about the code of this all at the same time. Yeah, so I'll keep the signals on. I won't turn on signal type just to save some real estate here. So now let's get into actually like calibrating this, because the settings that this ships with out of the box was my go-to like boilerplate. The scanning length set to 11, and then the cloud multiplier set to 1.618, which is a Fibonacci interval, by the way. Shout out to Welch for suggesting that, however long ago that was now. Out of the box, it works really well. The thing to consider, though, is that different stocks, different indices, different anythings all have their own rhythm to them, their own cadence. They can be heavily correlated to an index or, a familiar security of it. But at the end of the day, everything trades uniquely. And so when you have like a particular stock that you're really good with, be it like Tesla or, SPX, whatever it is, there are tons of little nuances that you can apply that actually let you have an even clearer perspective as to what's going on. And that's what I'm going to try to demonstrate here. Actually, you know what? No, let's do SPX or SPY. So actually, by the way, if you don't want the table on down here, I've gotten a few complaints excuse me, I've gotten a few complaints about people on mobile not wanting the table to show up. I am adding a feature that will allow you to customize where it's at and the size of it and so on and so forth. But in the meantime, if you don't want that showing up, if you go to the Style tab, right, and scroll all the way down, uncheck Tables, and that will turn that off. I'm actually going to do that in the meantime to get even more real estate. So we'll start with the micro tuning and then the macro tuning. Calibration, configuration, whatever synonym you want to use. So what would I consider to be a micro time frame? Pretty much anything from seconds up until 1 hour, maybe. It's kind of dependent on the trader. It's kind of dependent on what instruments you're using. But primarily, anything from seconds, like 1 second, 5 seconds, doesn't matter, all the way up to about an hour, I would say is micro. But micro is only micro relative to macro. So if you're looking at charts on the weekly all the time, then a micro would also be a daily. I'm sure I could come up with some theorem to describe what's micro and macro as a formula, but I digress. So here's the 5 minute, okay? And what we're looking for, I'm going to turn off the clouds for a second just to make this even more clear to see. What we're looking for, this is actually a really good region right here. We're going to actually put a circle on that. This is a really great example of the spring actually taking place, right? This is pretty agnostic. I'm not actually annotating Wyckoff schematics with this. That's not the approach here. It's the algorithmic approach, or not even algorithmic, just the pseudo logic to how accumulation and distribution behave, and we're adapting to that as the chart progresses. So when we're going about tuning this, what we want to identify in a way that we can go about this is we have one primary objective in mind, and that is to indicate reversals prematurely. And that's pretty difficult to do, but thankfully this tool is already really good at it on its own. So we want to identify bottoms and we want to identify tops. And so where can we see examples of that already happening, right? I'm going to actually set this to the base config. All right, so this is the out-of-the-box configuration. And we're going to see where we get our bounces and where we get our rejections. So if I'm sorry, I'm going to switch this one more time. We're going to go to futures because that's a market that's pretty much trading 24/7. That's not Bitcoin. And let's switch it to the 30. No, my mind's all over the place. Go back to the 5 minute. The other caveat here is adapting throughout bearish and bullish regions as time goes on. If your macro is in an upward direction, but your micro is downward, then you'll get some friction there. But nonetheless, just something to keep in mind. This region right here, I like this a lot. I like this a lot because this is already showing out of the box what we're looking for. We have our tops being identified before they even happen, as well as our bottoms. We can see that right here. Bottom, premature top. This is what we're actually going to be zeroing in on. Called this top pretty well, as well as here. Called the bottom. This was just a free trading range. The top, bottom, bottom. You get the point. So what we're actually trying to identify, and what our objective is we want to enhance the accuracy here, the consistency of it. Now, again, out of the box, this is already pretty decent, right? And once we have a region that is showing solid results, we can continue forward and double check that. Now, as you can see, that futures kind of overextended here, and so the regions of accumulation are way the fuck down here. But nonetheless, this looks good, right? I'm trying to see where things might become inaccurate. I mean, it's pretty solid as it is. Actually, let's focus on this. So this was premature, and this is what we're actually going to try to remove from our current config. So what went wrong? The region for a bounce was premature, and I say that because we can see the accumulation band hug to it, and we were getting some bounces, but nonetheless still fell through despite being on accumulation. We eventually did get the bounce we were looking for, but albeit prematurely. So the first thing that I would do, looking at this, is I would increase the scanning length. And what that will do is it's going to account more candles as time goes on, which decreases noise, but also decreases the reactiveness. And so that actually just completely foobarred this range. But the caveat is that we actually identified more ranges out of that. So if you're trading within, call it this amount of time, right? We're on the 5 minute, and we're going to say that's about 30 candles. That's 150 minutes, so 2.5 hours. If your trades last 2.5 hours, then, this is kind of the amount of time you're looking for. This is where you want to have things react quicker or slower. So because we're assuming that this is your trading range, we're going to put this back to 11. And so what our other option is that we can decrease the cloud sensitivity. I typically set mine to 0.5. And because we're still writing distribution here, that's actually not going to cut it. So we can decrease it some more. Not cutting it. We'll put it back to 0.5. We can decrease our scanning length. And still, because it's still in distribution, that's not cutting it. This is kind of a range that you can't quite capture because no matter how you look at it, it's in distribution. But what we did do is all throughout here, we actually caught this region of accumulation, and then on the reciprocal of that, caught the distribution, and it continued to push into it. As time went on, we did start to capture accumulation prematurely again, but within a really tight margin of error. So I'm actually kind of okay with that. And then looking even more forward here, catching it even more gracefully. And you can see how everything starts to fight itself. Things are bouncing, and then we're pushing into distribution, getting pushed back down. And then right here, that's where everything nosedived. So not really too much I mean, it's I hate to say it like this. It's already as good as it is, and there's only so much fine tuning you can get before you're fighting the fundamentals of how the indicator works. If it's in distribution, as it is, there's not much you can do to try to redefine an accumulation range within that on the same time interval. So if I set it to like 31, this is my more longer term config, and try to zoom out a little bit. We've actually identified more ranges, or less ranges, but they're more reliable. And we can see that all throughout here. We captured the bottom and the top pretty damn close without having too much noise involved. So let's actually kick it up to a more macro approach. Let's go to the 4 hour. And this is where everything really starts to shine, especially if you decrease your scanning length. It's amazing what you can get out of this. I'm even going to turn off the signals here just to kind of like capture the anatomy of what's going on. So with the scanning length set to 11 and the sensitivity of 0.5, what we have, and this is going over almost 6 months of trading, this is going all the way back to June, we can see that we caught the first accumulation a little premature, right? So we wanted the bounce here, and that's where we actually had a predefined range that was showing results. But as we got pushed back down, we did have a catch here, but we didn't quite react in time, right? And so what you can do, there's two ways you can look at this. You either didn't react in time, or you reacted too quickly, right, as far as the indicator goes. So you could decrease this to 5, and what's actually going to happen is that you're going to have an even faster reaction to this, but you have more bounces that are defined. Right, so originally we just had the 1 here, but now we have 2, and even 3, albeit you did fall again, but rebounded shortly after that, right? Or what we could do is we can kick this up, set it from 11 to 20, and now, still premature, but we have a new interaction here with the long-term accumulation region. Not once, not twice, not 3 times, not even 4 times, but 5 times captured the range of where we would be rejected and where our shorter term springs would be at. And you can see all of those bounces showing here. And eventually this caught into its own rhythm and took off, and then was calling the tops almost perfectly to the penny. Right here and here and here. We blasted through distribution, so that sustained another uptrend, and then just continued riding that, and then eventually got rejected, and that's where the downfall began. And then we found ourselves riding all the way back into accumulation, and here we are. And then we tried going back into distribution, got rejected off of the distribution rubber band and the long-term distribution band. Got our bounces, bounced off the long-term accumulation multiple times and the rubber band of it. But yeah, you know, we've identified the ranges almost pitch perfect. And that's on a macro time frame. So like within all of this, right, each of those candles is 4 hours. If you can call the bounce here, for example, right? So all of this and then some, right? Now, obviously, no one's going to have a perfect entry point or perfect timing. But for the sake of argument, let's just assume, right? So this is where, excuse me, this is where we're assuming that we're going to catch the bottom. Let's now go to a smaller time frame and see what this looks like. So you could have, in theory, you know, plus or minus whatever percentage you want to come up with. This was a 7.5% move. If you're playing 0-day fucking calls on SPX or SPY, like this is immaculate. This is like perfection. And even on the we're on the 30-minute now. Even on the 30-minute, we're just riding distribution, and then we get rejected up here, right? I'm going to change the color of this so we can see it even better or more clearly, right? So we were riding distribution, and if we go back to the 4 hour, where the fuck did that go? Yeah, that's a clear rejection off of our 4 hour. So if we go back to the 30-minute and reference that point, in theory, again, you're gonna have to get your own feel for this, your own eye for it. In theory, you could have bought puts as you were approaching that 4 hour distribution range, knowing that, and I'm sure you could probably see volume tapering off with this, but I digress. You could have bought puts, and then you could have rode those cocksuckers down all the way to here, which is where we got our next range of accumulation. That's 5.5%, and then waited back on the 4 hour for when you would hit the next point of accumulation, assuming that it calls that out. Yeah, it's insane. It's pretty fucking cool, you know. So that's the nickel tour over the course of 25 minutes. I will be releasing more videos like these, especially with all the new indicators that are coming out in the near future. Got a lot that I've been cooking up. Yeah, so let me know if you have any other questions, any other pieces of insight that you're seeking. I will be happy to go over those. And yeah, stay black.